right, I want to show you live shots right now of Port Newark in New Jersey, Port Liberty, Bayonne, New Jersey, two of the some 24 plus key ports and entryways for commerce in the United States. A lot of goods, a lot of boxcars find their way there to and from all points around the world. They could be eerily silent effective midnight tonight as 45 dock workers go on strike. The impact with all of that with Austan Goolsbee, the Chicago Federal Reserve Bank president. Austan, always good to see you. This is an event you and your colleagues at the Fed can't plan on. I understand that. But are you worried if this drags on?
Yeah, especially if it drags on. This seems like it fits into my old Chicago motto. I always tell you, Neil, there is no bad weather. There is only bad clothing. And things happen that we're going to have to take into account and deal with by how they affect the conditions. We've gone through, in the last year or two, a big strike in the auto industry. We've gone through the port collision with the bridge that affected shipping. We went through, in the pandemic, as you know, major problems with shipping and the supply chain. And anything that's a negative supply shock, in our language, that's going to raise the cost of doing business or lead to shortages is something we're just going to have to deal with, and the impacts are never good.
Yeah, I guess if it comes to a strike, once one is on, it could be weeks long, and it go to your fears, Austan, it could raise prices, and that could get in the way of this recovery that you said showed a golden path a little more than a few days ago when you said that. Are you worried about that recovery now?
Yeah, look, central bank's job is to be worried about everything, and there shouldn't be anything that you can come up with that we haven't at least thought of that it's a possible complication for our plan. That said, we set an interest rate very high more than a year before and held it there, and now we've started reducing that rate because conditions have gotten more back to normal. I mean, if you look at the new inflation numbers, they're coming in relatively pretty close to target. And if you look at the unemployment rate and the job market, we've gotten back to a steady state, kind of a sustainable level that's close to what we think of as full employment. And if you think of, in my mind, I think of it a little bit like the bathtub. You know, you want the water to be the right temperature. If it's too hot, you got to add cold water. But once the bath is the temperature you want it, you got to reduce the amount of cold water you're adding. And so that's why, as I look out over this next year, interest rates coming down is going to be the order of the day, because you want the rates to be normal, just like the other conditions getting back to normal.
Yeah, I just wonder, that cold water, do you need, you know, a quarter point of that, or do you need a half point of that to sort of deal with it at the next meeting?
Yeah. Depends what the conditions are, you know, and the more you're seeing these disruptions, I'm still pretty hopeful that if you see a lot of the evidence on just GDP growth and how fast the economy is growing, you're seeing some of the private sector forecasts and the Atlanta Fed's GDP now upping their estimates of what this quarter's GDP growth is going to be. But there's some cautionary indicators on the job market side, and just the way monetary policy works. As you know, you can't wait for it to happen before you start trying to get yourself into position to react, because there's lags in both the data.
I understand that, Austan, but that sounds like a quarter point cut. If you had your druthers now, it would be a quarter point.
I would say the most important thing is not for one meeting, is it one cut or two cuts at that meeting. Right. The most important thing is this is a process over a year or more that we're trying to get the rates down to normal to keep conditions at these decent dual mandate situation, that inflation and unemployment are around the target. So it's got to come down a lot more than 25 basis points over the next 12 months. It's going to be a lot of cuts. And if you look at the statement of economic projections, you see it's pretty widely viewed as going to be appropriate by almost everybody.
Yeah, I've heard like in the 3 to 3.25%, 3.5% range a year from now on the Fed funds rate. I don't even know if that's accurate, but I did want to get your thought. Maybe you could tell us after the fact whether when you guys all deliberated on that half-point cut at the last meeting, well, some of you were concerned about its timing so close to an election. I know that's never supposed to interfere, but some of you, maybe you yourself, Austin, thought, well, we know what Donald Trump might say. We know what Republicans might say. What do you say?
Well, look, what I say is for a year and a half, we've been laying out the economic conditions that would be necessary. Why do we need to raise the rates as high as they were? Why do we need to hold them there high for more than a year? And what would need to happen for us to want to start cutting the rates? And if the economic conditions, which are the thing that drives the Fed's decision making, reflect exactly what we've been saying, to not act in the face of the conditions would itself be a political act. So when you become a sworn member of the Federal Reserve, you're out of the elections business. In this thing, the inflation is coming in close to target. The unemployment rate is up to 4.2, which is around where a lot of people think is sustainable full employment. And the rates are well above where almost everyone thinks that they need to end up. So we got to start moving when the conditions are like that.
Got it. Real quickly, I don't want to belabor the point, but Kamala Harris is talking about dealing with price gouging going on at grocery stores, and that's why prices have rocketed to the extra degree they have. Do you buy that?
As I say, I'm not in the fiscal policy business. They're going to have an argument in the election about what they want to do about prices. The Fed's job is to take fiscal policy as a given, and then we're going to have to react to it. So,
I know that, Austin, but you're also a very smart economist. You're also a smart economist. Has that been a factor here, price gouging?
Well, look, all of that depends on how are you defining what price gouging is. And all I'll emphasize from either side, if you're interpreting business markups as the measure of price gouging, just be a little careful, because that has a dynamic over the business cycle that they go up, they go down, because wages and prices move at different speeds.
I wish we could have talked more. I wanted to talk and send along my lamenting for the Chicago White Sox, but for you, that's probably a good thing that we didn't get into that.
That was a low blow, Neil.